So Richmond Fed, Empire Fed, now this. Is it starting to add up or not, David?
I don't think the econ slowdown story is really starting to add up. I think there are a lot of disinflationary pressures that have been building, particularly we've seen it now in the oil markets. The fact that the Fed didn't acknowledge that was probably a bit of a problem, but I'm not jumping on this big slowdown story. I think the market's getting a little confused with supply side disinflation and sort of slowing economic activity. I don't think those two are as correlated.
Well, either you believe the markets or you believe the economy. Who's generally right?
I think the markets are responding to a very confused message from the Federal Reserve System. It started in October, it got kind of fixed in November, and it got kind of screwed up pretty badly in December. I don't know how easy it's going to be to come back. I thought John Williams did a great job with you guys the day after the Fed meeting, and I think John and Rich Clarida are going to probably be the two guys that clean up the mess a little bit. I don't know how long that will take, and what we see from Jay will matter in the coming months, but this was not what the market was expecting. It reeked a little too much of politics and lines in the sand, and then to have the president come on afterwards and fight it out, it really has people questioning the institutional force of the Fed, which has been with us for the last 10 years, driving this market.
Because of internal dysfunction or external pressures or mix of everything, or what?
I think it's a mix of the Fed taking its independence very, very seriously and aggressively and maybe drawing some lines in the sand and not really realizing that the battle was going to be as aggressive as it was. And I think Jay showed a bit of stubbornness in the press conference and in his actions. There was a lot more humility from John Williams in that discussion, and I think that's what the market wants to see. The market wants to see a Fed that's going to react, that's going to be there if things get really messy. I personally don't think the economy's on some precipice like a lot of people do, but you want to know that the Fed's there if it is.
Evan, do you agree with that? And I mean, I guess it begs the key question. You could talk about President Trump and the tweets, but you could also talk about some of the other things we've seen, including the comments from the Fed chair recently. Has the Fed become politicized?
I don't think so, and I think that came through strongly in the rate hike in the press conference. Look, this is a Fed that is data dependent, and it's not going to suddenly adjust. We can't expect them to suddenly back off rate hiking. It's, this setup for a pause is a process rather than an event. And we saw the first step in that event in December. We're going to see further steps, and we're starting to see the economy cool a little bit. I agree with David that we're not falling off a cliff, but that moderation in data will give the Fed room to become a little bit less hawkish, and I think that will ultimately support the market.
So to the degree we see data that's marginally down, right, or softer, does that clear a path to a March, skipping March, and is that why maybe we can rally even a tiny bit on weak numbers?
I think so. Look, I think strong numbers actually might be more complicated for the market because it's going to throw a bit of questioning into everything. It's not going to be what you really want, particularly if those are on the inflation side. Now, I don't see that, and I think this year we've really seen an unbelievable turn in the inflation data since the summer. It has been extremely weak. The oil market's weak, but even the internals of the core PCE down significantly and decelerating. I think the Fed had every reason to put a hard pause into the marketplace. It was all set up for that. And I think politics got in the way and their ego got in the way a little bit, and that's what we're fighting right here.
So I hope it works out. You think they were trying to make a statement against the president, saying...
I think there was something in there, and that is somewhat problematic for the market to see, because the market's just
I agree,
not
David,
ready.
but if that were really true, I mean, the dollar's up over the last 3 months, over the last 6 months, for the quarter so far on this brutal equity market. I mean, you really think you would have money flowing in and confidence in the U.S. dollar if there were serious questions about the Fed institution and credibility? But
real rates are headed higher, Sarah. I mean, inflation expectations are dropping, break-evens are down. The support for the dollar is real interest rates. That's what FX guys always look at. And real interest rate differentials are all pointing to dollar strength. I get the credibility argument. I get the confidence argument. I also think the market's probably looking through it and knowing that if there really is a battle between the Fed and the president, if you go back in history and you look at Lyndon Johnson and Bill Martin, if you look at Arthur Burns and Richard Nixon, and even if you look at what Paul Volcker was saying with Ronald Reagan after his recent book came out, the president usually wins these things. They're pretty powerful. It's a hard fight. And What I'm not sure is, why does the Fed want to fight this battle? Inflation is going down, not up. You would want to fight this battle
I don't think
if the PCE was at 2.5.
I think that what Jay Powell was doing was justifying his rate hike, mentioning the economy and a number of the indicators. I think he was also trying to represent his board. I mean, he was not the only one expecting 2 interest rate hikes next year, and I think that he had to speak to the consensus on the committee. 17 members put out their forecasts through the dots, and they were trying to justify it in the data.
I agree, but you could be a little more flexible with a little bit more sort of openness to this could go either direction, as opposed to the rigid, we're not touching QT, we think there's 2 more rate hikes, everything looks great, everything's wonderful. No, the market wants to hear, you know what, maybe everything is wonderful and that's your view, but if you're wrong, we need to know that you guys are in the, in the back seat making sure this is going to work out, like you have been for the last 10 years. And you didn't really get that feeling on Wednesday last week.
Evan,
I did.
You agree with all this? And if so, does it lead you into at least a tradable rally?
Well, I think I see the Fed as less politicized, I think, than David does. I think, look, the Fed really wanted to get to the bottom of their range of what they view as neutral, right? They wanted to get there. And with this hike, they did get there. And so now that gives them the space to look around, see how the economy does. Do I agree that it could be communicated a little more effectively? Sure. But look, they're now at the bottom range of neutral. The data is going to cool a little bit. They have time, and we will see them come in a little bit more dovishly, and that should support the market.
You know what's incredible to me? We're sitting here having a conversation about the Fed and specifically disinflation. We're not talking about U.S. and China and the impact of tariffs. Is that the boogeyman that has gone away?
I think that uncertainty is very much still with us, and it's not just trade, it's about tech. We heard overnight that President Trump is considering executive orders on export controls to Huawei and the like. And even if we get a tariff deal, this concern about national security and regulatory issues in the tech sector, that's, I think, definitely a headwind and something that's weighing on multiple. So it's not all the Fed. We do have some genuine geopolitical concerns here that the market's grappling with.
But we're not talking about higher prices due to tariffs right now.
Definitely not. In fact, we're talking about almost lower prices, grains, exports, things like that. I mean, what's really amazing is that anyone who put a Phillips curve-based model out there and told you 3.7% unemployment rate, we've got to be vigilant, we've got to be raising rates, this is almost a joke now. We have massive deceleration in inflation. I think the core PCE is running at a 1.2% annualized rate over the last 3 months. It's just...
Right. But if tariffs go to 25, you'll be back and we might be having a different discussion.
Yeah, I actually think that if tariffs go up significantly, the amount of slowing that we see globally, the global slowdown that comes from that, the aggregate demand slowdown globally, will be very disinflationary. So you're not going to get me to sort of jump up and down about tariffs being super inflationary either.